Hello, welcome to 30 Minutes. I'm Rick Anthony. From time to time, I invite guests to come back, particularly when there have been a series of events since their last appearance, so that we can talk about the effect of those events on positions they've taken, on attitudes and comments they've made. In this particular case, my guest today is Mike Dever, who is an author, investment money manager, an entrepreneur. There's a number of varied interests, but they all have to do with money. Welcome back.
Thank you, Rick.
Good to have you again.
It's great to be here.
The first time you were here was to talk about your then new book, and this goes back to probably the springtime
Correct.
of
Late
this
spring.
year. I'd like to talk to you about the book, how well it's doing. But before we get into that, would you remind the audience who you are, where you come from, and why and how you got into this business of managing other people's money?
Absolutely. I started trading about 30 years ago, mostly in futures and commodity markets, but it evolved into trading equities, long-short equities, market-neutral equities, really anything that was non-conventional for the most part. We weren't just buy and hold investors. And then in the 1990s, I got involved with an internet company called Spree.com. I founded that in 1996. That grew to being the 7th most trafficked e-commerce site by mid-98. I brought in venture funding to that in 1999 and left to start a company called Mind Drivers that's involved in venture development and various technology businesses, Internet Seer, which is one we built and sold and then repurchased, Marine.com, which is online boating supplies, and then just most recently back to trading again on a full-time basis with Brandywine Asset Management.
And you're based in Thornton,
That's correct.
Pennsylvania, in a marvelous old building called
It's
the Old Mill.
It's a great building. It's
Yeah.
a 17th century grist mill we restored.
Yeah.
So we've got a 20-foot water wheel and a creek running through the building. It's a great atmosphere.
And I remember it as a restaurant.
It was a
and
fantastic
years
restaurant
ago.
for
It was, yeah.
50 years.
Yeah, it was a destination with that water wheel, the paddle.
That's right, yeah.
It's a marvelous
A
building.
lot of history in that building.
There sure is, yeah. And you've restored it and done a great job with it.
Thank you.
I think it's your brother who's the architect?
Tom Dever, yeah,
Tom Dever,
my
yeah.
brother's the architect.
Okay, let's get to the book. And because that's, if there's anything on the minds of most people today, is how to make and keep as much money as possible. What compelled you to write the book? What's the book all about?
The book exposes 20...
First of all, in case
Okay, ahead.
Jackass Investing, in case you can't read it. Jackass, excuse me, Jackass Investing, don't do it, profit from it.
Correct. The title came out of when I was writing the book. It was exposing 20 common investment myths. And as I'm writing them, I started realizing what they were really doing with these myths was the common investment wisdom was teaching people to gamble with their money, to take unnecessary risks. And to me, the definition of jackass investing is taking unnecessary risk with your money. So I go through the book and I go through myth by myth, explain what myth is, why people may believe it to be true, but why it's actually a myth. And then on the website for the book at jackassinvesting.com, I lay out some specific action points people can take to take advantage and exploit those myths for profit.
And you list the 20 myths in the table of contents.
Correct.
Of the 20, this is not a fair question, but of the 20, which do you find to be the most prevalent and the most troublesome?
Well, the most important that's also prevalent and troublesome is what I consider to be the final myth, which is why I laid it out at the end. There is no free lunch. The belief is that to get additional return, you have to take unnecessary and additional risk. And that's absolutely not true. And the reason the belief exists, though, is because people are taught to gamble with their money. They're taught to put a little bit of money in stocks, a little bit of money in bonds, maybe some money in real estate. And within that small box, if you want to get a higher return, you do have to take on more risk.
Right.
But if you expand beyond that box, and if instead of looking at each of these asset classes, and I talk about asset classes in the book, you instead look at return drivers and diversify your portfolio across return drivers, you can get better returns and reduce risk.
And what's a return driver?
A return driver is that individual, specific driver, it's a very simple term, that drives the returns of a particular investment. An example would be, in myth number 1, where I talk about stocks providing intrinsic return. There's no magic intrinsic return that comes from stock, owning a stock. The returns are derived from really 3 primary things. One is the earnings growth of the company. The second is the multiplier people will put on that earnings growth, the PE ratio. And the third is the dividends. And when you look at it under a short time period, and I mean short by 20 years or less, so it's what people would consider to be long-term, that the dominant return driver is people's enthusiasm for stocks, the expansion or contraction in the PE ratio. So you can analyze companies all you want and say, oh, this one's got good growth prospects or whatever, but it goes up and down more because what people believe it's going to do than what the stock's actually doing.
Are you saying the snapshot is a 20-year period?
Up to a 20-year period, more than half of the return driver, when you do regression analysis of the return on a stock, is driven by the expansion or contraction of the PE ratio, not by the earnings of the company.
Okay.
After 20 years, the earnings of the company, the earnings growth actually starts to dominate the performance of a stock. But up until 20 years, it's
Why 20 years?
What we did, I don't really know why. I just know that emotions dominate short-term and even intermediate, and what people might consider longer-term stock performance. It's not the performance of companies overall. It's the it's the emotional belief people have in whether stocks should be bought or should be sold.
Myth 3. How often have we heard this? You can't time the market?
Correct.
God knows we all try.
Absolutely. And the problem with that, it's both true and false, this myth. It's true because most people cannot time the market accurately. All those facts show that. The studies show that over the last 20 years, the average mutual fund investor has underperformed the mutual funds they invest into by 5% a year annually. Bond market investors, 6% annually. It's because they get emotional. And when stocks are going up, they jump in and they want to buy it, but they're buying the most at the top. And they're panicking and selling out the most at the bottom. The reason it's a myth, though, is because if you systematically follow a plan that does the opposite of what they do, and I talk about in the chapter the opposite TV show that was on Seinfeld, the opposite episode, it's a great episode, it's really funny, but where George realizes that everything he's done in his life, everything is wrong. And he just does the opposite of what everything he was going to do. He walks up to the girl at the bar and says, the counter, and, you know, I'm unemployed and live with my parents, and she wants to go out with him. Well, that's how you need to act as an investor. Because if you do the opposite of what the other people are doing, you can time the market more accurately.
Isn't that simply called contrarian investing? Isn't that what Warren Buffett has made his bazillions on?
Exactly, and I have Warren
when other people panic, he buys.
No question, and I have Warren listed throughout the book, and in timing the market, especially I talk about it, because Warren Buffett had his record largest cash position going into the financial crisis in 2007. And everybody knows what he did after that. He bought Goldman Sachs, you know, bank stocks. He bought pipeline companies at severely depressed prices. You know, he's a market timer.
Yeah. So there must be some magic to it, or is it just common sense? You look at three variables, three factors, you watch them, and if they converge, you do something.
Well, I present an actual strategy on the website in the action section that looks at the cash flows in and out of mutual funds to determine the best times to be buying and selling the market overall. But remember also, we're talking about one small piece of somebody's portfolio. Unfortunately, most people have stocks dominating their portfolio. It should just be one return driver out of dozens.
You also talk about the myth buy and hold. Vanguard, not to mention one, but Vanguard, built an empire on Bogle's philosophy of buying and holding.
They did.
And then what happened?
Well, exactly. I mean, he started preaching that at the exact right time, because for the next 20 years we had one of the biggest bull markets in the history of this country. And buying and holding was the best thing you could have done. Almost any sell during that period, you would have worked out to be worse than had you just bought and held it through that entire period. But if you look back over 100 years, and I do in the book, you've got extended periods where the real returns of the market is not positive. For the most part, from the beginning of the century to the mid-century, it barely moved. If you look at the 20 years of the bull market, started from 82 and went up to 1999, 2000, that period, that accounted for virtually all of the profits and real earnings out of stocks over the last century.
Full generation.
It was a great run. It was a great move, but it trained everybody that you just buy and hold and you ride it out.
Looking through the table of contents and reading some of the chapters, the word that comes to mind is moderation. In almost every instance, it's not that these things are in themselves intrinsically good or bad, right? It's the extent to which They dominate one's thinking and behavior to an extreme. But these things in themselves, in moderation, are for the most part neither good or bad.
Well, that's really a theme, probably a central theme running through the book, is that diversification is the one true free lunch. Portfolio diversification. And don't commit to any one style of trading or any one return driver. It'll work for a while, just like owning stocks. The return driver of really betting on people's emotion and increasing desire to own stocks worked great for 20 years. But everybody then started gravitating to relying on that single return driver. It's going to fail. No single return driver works all the time. You have to diversify.
But we had an entire cohort, 79 million boomers, who grew up with these myths, who were conditioned to believe these things by the experts, the people who were advising them, mutual funds, individual investors, whatever. And now you're saying, through your book, you're saying to them, no, you're not saying you've been wrong for the past 20 years. You're saying it's time to rethink.
I think it's always been time to rethink. I started writing this book in 1999. That's when the concept of it came to me. And the problem you have, and I had covered it in my chapter, it's best to rely on expert advice, is that people are conflicted. The experts are conflicted. The gurus, the investment managers, they all have a set philosophy that they're locked into. Not all maybe, but most of them. And they have a hard time opening up beyond that. And they have a product to sell or a process to sell.
Does that tend to be a generational thing?
I don't see it as generational.
Are younger investors de facto smarter investors?
No.
Because they're not locked into these myths?
No, not at all. I think you've got, jackass investing across the spectrum, right? I don't think it's one age group or not.
Nobody's got a corner on it.
Yeah, and what you're seeing now actually is the younger investors who are saying, I'll never invest in stocks. Some of the largest percentages ever in the surveys of the Y generation and the younger generation saying, I'm never going to invest in stock. I mean, and again, I don't say that in the book. I think it should just be part of it. They're radical on the other side now. They've gone totally the other direction.
Since we last met, the market has certainly been as volatile as we expected it would be. It's getting scary with world economies collapsing, countries, sovereign collapsing, and now the prospect of worldwide recession. And nobody's having enough money to pull us out, not even Germany, but certainly not the U.S., unless we get it from China. Have the events over the past 6 months or so, 9 months, since we last sat together, changed your thinking in any way?
Not at all. I mean, it's only reinforced what I've been believing for the last couple decades, what I started to write down in 1999, what I've put in the book. And that is that the majority of price action is driven by the emotions of people. You need to diversify across a broad range of return drivers. People have to start facing the fact that they can't time the market well emotionally. They have to have a systematic approach. They can't just rely on buying and holding it for the long term, because the math looks at the next decade of about 3% annualized returns from stocks, less than 2% from bonds. I mean, that's if you just work out the numbers, where we are today, that's what you should expect. And
for how long?
Through this decade. Through this decade.
That's pretty grim.
It is if all you look at is what the conventional wisdom has taught people to do, which is put 6% bonds, 40% or 6% stocks, and 40% bonds. Then it is grim. But there are so many different opportunities out there and things that people can do with their portfolio to diversify it further. And that's the whole purpose of the book, is to focus on the return drivers, get people to diversify their portfolio, not to just sit there in one position hoping it works.
But is, in your opinion, and with as little bias as you are capable of, can the average person do what you're suggesting? Be smarter, be less of a jackass, using the tools that are available today to do the analysis, to help decision making and so on, and to move quickly? Or do they need the expertise of an advisor?
There's two ways to go about it. The one is to become an expert, or at least as close to an expert as you can on your own. And more people spend time looking at a house or buying a car than they do with their investment portfolio. They spend more time looking at a phone to buy. than their investment portfolio
I
for the
think
most
largely
part.
because it's so intimidating.
It could
And
be.
the consequences can be dire if you make the wrong move.
I think that's true, but I think part of it's because they haven't been taught the right approaches. I really do think that's part of it. But at the same time, there's more tools today available to make people be able to create a properly diversified
Yes.
portfolio than there ever was before. And not by actually learning to become an expert, but there's ETFs and mutual funds out there now that are engaged in the strategies that if they became an expert, they would engage in. They don't necessarily have to become an expert now. They can just find those ETFs and mutual funds that are engaging in those strategies and put their money in those.
Okay. Talk about psychology and the influence of emotions again. Do you feel going forward, once again, with all of the analytics that are available, all of the alternatives to most, even small investors, that people will continue to make decisions from here rather than here?
Yes.
You do?
Yeah.
Why? Haven't we learned anything?
No. People will. I've been told for 30 years of trading that when somebody finds a system, it'll stop working because then everybody will do it.
Yeah.
They don't. They do it and it starts to fail, which they all do.
Yes.
And they abandon it. And they jump onto the next thing that's been working. And it's not just individual investors. It's the institutions as well. To me, an institutional investor, for the most part, is just an individual with more zeros that they're managing. You know, they're not necessarily any more disciplined than most of the individual investors that are out there. We're an emotional species. I think that'll continue.
And how do you feel about the rush to gold and silver and other commodities?
You know, it's another emotional move. People started really getting into it this summer. And of course, that helped drive up to peak to the market after 11 years.
Yeah.
You know, I mean, where were these people in 2000 when you could buy gold for $200 an ounce? You know, they weren't around then. Yeah, but now they're hearing about it, they're buying gold. To me, everything is really a trade, and I talk about it in the book. You know, gold is good for buying and selling. And just like stocks, if everybody's jumping in, well, that's usually a good time to sell the market, and whether it's gold or stocks. And you don't have to short it. You could, because to me, it's no different than being on a long position, being short position, betting on it going down, if the return drivers are warranting that. But it's just, to me, it's another example of emotional reaction. People finally build up. They ran silver up, you know, doubled.
So you don't favor having some of the person's portfolio in commodities?
I think that you need to look at the underlying return driver.
Yeah.
And if the market conditions and the return drivers are still saying that you should be long those markets, you should be. But if you shouldn't be long those markets, you should either be out or you should be short. You know, so I don't view any market as being in it for the long term.
Okay.
I just don't think nothing's ever warranted that over time. If you look back, you can go back centuries. Nothing goes up forever. And so you always want to be flexible, and when the environment changes, take the other side of the trade, or at least get out of the long position.
What do you see? I realize I know you're not an economist. You're not a PhD economist, but your guess is as good as any, probably better than most. What do you see about inflation over the next 3 to 5 years?
I think we're in we're going to be ongoing again through the rest of this decade, a deleveraging. We're nowhere near deleveraged yet. The individuals have started deleveraging. They're the most of all the individuals.
Explain what that means.
The people took on credit card debt.
Yeah.
People took on home equity loans, and that debt got to 135% of disposable income. You know, it's now down to maybe 115. It normally should be around 75%.
Okay.
It's still substantially above where it should be.
So we're still correcting.
But it's come down.
Yeah.
But that's only individuals. Corporations have done a decent job. But governments, when they saw this debt liquidation going on, they panicked. So what did they do? They created more debt to counteract that, because that's a deflationary force.
Yes.
So what people that are looking at inflation are missing is that you have huge deflationary wave going with individuals and corporations still who aren't leveraging. All the debt build is on the government side. I don't think we're going to have a full, true recovery until the governments realize you can't inflate out of it.
Yeah.
You've got to let debt contract across the board, even at the government level. So I expect there to be subdued inflation still over the next few years, because of this debt overhang that's still being
What's the
unlocked.
real rate of inflation today? Not what the government tells us. What's the real rate?
Yeah, you've got the shadow rates out there that people are putting in there maybe twice.
Yeah.
Where it currently is. That's quite possibly true. It really depends. It's so product by product focused. As long as there's free trade, inflation will still stay pretty low. If we start putting constraints on free trade, if the government even overwhelms the liquidation of debt that's going on by individuals, you could definitely have that ratchet up. But I don't really see that. I don't think that's the scenario.
Do you see anything, Mike, or say anything rather, in your book about real estate investment?
I do cover it only in the free lunch portfolio where we incorporate it in the free lunch. And I created free lunch portfolios that include mutual funds and ETFs, just so it's easy for people to create a diversified portfolio. And in that I have REITs. So I do think, real estate is actually, if you look out over the next 10 years, I believe probably of the stocks, bonds, and real estate, that'll be the highest performing class because you still get higher returns on the rents, and you've had a nice little shrinkage in the
But it's another
capital.
example, isn't it, at least currently, of the government's not permitting deleveraging. Let the market, the real estate market, bottom out on its own.
Yeah.
Stop propping it up artificially.
Yeah, it would have happened already.
Yeah.
But we're still at least a year away from that happening.
I think it's beyond the comprehension of most people. I think it really is intimidating. All they have to do is listen to the news, read the newspapers, and they've got to be concerned about whether or not they're smart enough, have the resources available to them, or can trust other people to help them manage their dwindling resources. With a 401k, those who still have them and there's anything left in them, they get some assistance, and the choices are relatively limited.
That's the problem. Yeah.
Is it a problem?
No, it's absolutely a problem. Now, I've been reading too much about people saying if you inundate people with too many choices, they won't make the right choice with their 401k. That's not the problem. The problem is that they don't have enough choices to truly diversify their portfolio. All the 401k choices, for the most part, are long stocks, long bond strategies. They might throw in one or two alternative type investments. Not nearly enough, if you see my free lunch portfolios, to diversify properly.
But Mike, when I was with a large consulting firm and we were designing and communicating and administering 401k plans, we went through a period where employers were providing a dozen, 24 alternatives, investment options. And it just confounded most employees. They didn't understand it. They were overwhelmed. And so they did make bad choices because they went for fixed income, they went for bonds, they went for safe. They didn't want to take risk because there was too much risk and there was no way for them to calculate it, compute it, and try to manage it. So I think there can be too much choice for most people.
I think if you say, here's your 50 funds and you can select from, they're going to pick the wrong one.
Blow the minds.
But if you create, like I do in the book, specific portfolios that say, here's the most diversified of portfolio options. It includes da-da-da-da.
Yeah.
And they just take that portfolio, which includes these different ETFs. They're not timing in and out of different ETFs.
Got it.
They're in that portfolio. That's what needs to happen with 401ks.
Okay. All right. And the portfolio is designed for an individual stage of life,
It can
how
be,
far they
yes.
are from retirement.
Right, but out of the gate, it'll be more diversified than anything that I've seen offered in 401ks today. More diversified. More choices does not mean more diversification. Because it's essentially the same thing
That's a good point.
over and over, just more leveraged stocks, more leveraged bonds.
Yeah. Okay. What concerns you the most going forward for the average small investor?
I think people are going to continue to get bad advice. It's out there. It's in that. The reason writing this book was to counter that to the best of my ability. But I don't think most of the professionals know what to tell the people, and especially after the last decade. They don't know what to tell people, but they have to tell them something. So you've got people that are locked into the buy and hold mantra because they don't know what else to do. You've got people saying, well, I got to do something or I'm going to lose this client, so I'm going to get them into gold.
Yeah.
Because they hear about gold and they're trying to accommodate them. Instead of just, hey, tell them the truth. What you're doing is wrong. It's not going to work. What I've been teaching you has been wrong. Here's a new approach. This is the right way to do it. You can create a properly diversified portfolio. I don't think they're going to continue. I don't think they're going to get that advice.
Tell us something about Brandywine Asset Management.
So,
And how are you different?
Okay, so Brandywine, we focus only on one subset of the free lunch portfolio that I put in there. Over the years, we've traded equities, we've traded a variety of different asset classes. Today, we're totally futures focused, managed futures, and the reason we are is because we can trade over 100 markets globally with one instrument type in futures. It's very liquid to go long and short, so we're in commodity markets, we're in currency markets, stock indexes around the world, bond and money markets around the world, 100 different markets, and it allows us to get the best diversification, which gets the highest return at the lowest level of risk.
So you're not betting on individual stocks?
No, we're not. We're betting on indexes in Europe, Asia,
right.
United States, South America.
Yeah.
And for that stock portion, that's one of 6 different sectors that we trade in our portfolio.
And which of the foreign markets is the most promising over the next 5 to 10 years?
We don't really look at it like that, because we're really...
See, I keep asking the wrong questions.
Well, it's a great question, but because we're looking at the individual return drivers at any moment in time, what they're indicating which should be long or short. For example, during the summer, I mean, we did great through the summer with the big sell-off in stocks, and we did great on the long side in interest rate markets as interest rates came down and bond markets rallied. That was great for us. Now we're pretty well balanced. Stocks go up or down, it doesn't have that big an impact on us today. There were times when commodity markets, when they were falling, we were doing great on the short side of commodity markets. So we're looking at a lot of different strategies that are each driven by a separate return driver to trade across these 100 markets. It keeps us broadly diversified and in sync with the markets.
But when the average Joe or Jane reads Brazil, hot country, hot economy, doing very well, we should be doing some of what they do. We should be emulating their healthcare, et cetera, et cetera.
Right.
So everybody rushes to Brazil.
That's a different topic for me, whether we should be doing something from an economic standpoint or doing something from an investing standpoint. And when I'm describing what I'm doing investing-wise, I don't expect the average investor to do that. That means that you really have to become an expert to do that. But there are now vehicles out there in ETFs and mutual funds that are doing things like we're doing. We're geared towards high net worth investors. We're not structured. We don't have a fund that we can take smaller individuals into. We're managed accounts, more institutional focused. But what we're doing, there are people emulating that or trying to do that in mutual fund structures today. And that's where the smaller investors should have certainly a portion of their money.
So most of your clients are institutions?
Or high net worth investors. High net worth meaning the net worth of $1.5 million or higher. That's our requirement, and it's a regulatory requirement for us. And people can come into open a managed account with us, and for as little as $100,000 you can invest with us. But it's you have to have $1.5 million net worth to do that.
And business has been good?
It's been great. Yeah, we're trading well, and money's flowing.
Is there a sequel to Jackass and Investing?
If there is, it's an update more than a sequel.
Yeah.
Because there's not a lot I've changed in there, but every day I see new examples that I could put in there. Just in the last week or two, Chavez nationalized chemical company, and it was big announcements. I mean, it's been done before, but it was really back in the news again in Venezuela. So I talk about some of the past nationalizations in there, and there's always new examples.
You have a website?
We do, www.jackassinvesting.com.
Okay, and does that include ongoing commentary?
It does. I have a blog in there. I'm not a real prolific blogger. If I have something I think is worth saying, I'll say it. It's only once or twice a month, maybe.
There's no newsletter that goes out?
No, I have the newsletter set up on brandywine.com, so people can go to www.brandywine.com and sign up there, and we send out a newsletter.
All right. So your prognosis in 25 words or less for 2012 is?
I think more muddling, but definitely an improvement in the U.S. economy throughout 2012.
And bigger and better opportunities, therefore,
well,
for smart investing.
There's always opportunities.
Okay.
I don't think that changes. I think they're just going to be different ones.
Okay, fair enough. Well, I'm confused.
It wasn't my intent.
And I'm a jackass investor, and I've got a track record to prove it. At any rate, the book is Jackass Investing. They can get it on Amazon, I assume,
Correct.
or your website. We'll have you back in another 9 months or so and see how things have gone. Thank you very much for being here.
Thank you, Rick.
The book again, Jackass Investing, the author, Michael Dever. Until next time, this is 30 Minutes. I'm Rick Anthony. Take good care of yourselves.